Today's presentation or discussion is on gold, very topical at the moment, more so after the recent events today in Switzerland when the National Bank of Switzerland actually intervened and put in a physical floor on its own currency. And what we want to do is focus on gold, but then of course keep it very current in terms of what happened today and what may happen over the next few weeks and months. The title of today's webinar is Gold's Mountainous Peak at Risk of an Avalanche Decline Beneath $1,600. Our marketing team very kindly helped out with the design of this wonderful picture of Swiss mountain Alps. There is a story behind this, and there's a reason why we've chosen this. Obviously, the impressive rise on gold is one of the reasons why we've chosen this picture. But I will actually just make a point as to things to watch out for if you are very positive on gold and how it links into this picture. Now, before I start, just want to quickly also make the point that if there are any questions that you want to ask, I'm more than happy to answer them now throughout the webinar. But if we do run out of time, and traditionally I do overrun it by a few moments, please feel free to reach out to me and send an email to my email address here at MIG Bank in Switzerland. It's on the screen just there. If you can just write it down, r.william@migbank.com. We also have various social media sites such as Facebook, Twitter, where you can find MIG Bank. And I'm also subscribed with the forexstreet.net blog section where I update on an ad hoc basis. Okay, so they're all my contact details, email, social media, and also blog details for the FX Street website, if any of you here would like to communicate with me afterwards. Now, I always just give a quick roundup in terms of what it is I look at in terms of the trading techniques that I've specialized in over the last 2 years. I've been in the business for just over 10 years, working for various organizations. And the 3 areas that I focus on the most are on the screen at the moment. Can everyone see the screen at the moment? Just want to make sure that everyone can see what I'm seeing. You see a slide just basically saying knowledge. And at the top, market cycles. This alludes to price and time cycles. So just understanding market timing and when things happen rather than by how much they happen, but when things happen, the million-dollar question. But also understanding economic cycles, so how different markets interrelate or correlate with each other. Probably one of the most interesting areas you can focus on in today's volatile markets is just by understanding the relationship of different markets and how that will impact various investments and trades that you might be looking at. Second thing that I look at is chart patterns. So in terms of historical price patterns repeating themselves and how we can actually take advantage of these opportunities. But very specifically, I will look at Japanese candlestick pattern, which is a very timely trading technique, which can offer signals in a few hours or a few days or a few weeks, and can be a very good way to actually maximize profit, but also reduce risk, which is probably my main focus nowadays. Last but not least is a lot of the work that I've done on advanced indicators such as DeMark indicators. DeMark indicators has been developed by a very influential and successful investor and trader called Tom DeMark, and I used to work with him on an ad hoc basis in my previous employment. His indicators basically look for exhaustion points in the market, so they look for reversal points in the market. Most indicators are trend following, so most people will follow a consistent move in the market, if it's up, down, or sideways. I also look at trends, but one of the important points I always keep in mind is when that trend may show signs of reversing, exhausting, and potentially just turning completely around from a positive trend to a negative trend. So I use DeMark indicators for that to just give me a warning sign when a trend may be exhausted, and I also use my own proprietary strategies. Incidentally, one of the key signals that I will talk about as to why gold may be showing exhaustion, momentum exhaustion at the moment is DeMark indicators. So I hope most of you are aware of Tom DeMark's indicators, the last webinar I gave was actually on his most popular indicator, which is TD sequential, Tom DeMark sequential indicator. Now, before I move on, I just want to quickly ask a question. We have almost 100 people in this webinar today, and I just want to find out how many people in this webinar attended previous webinars that I gave here at MIG Bank with FX Street. So if you could just quickly in the chat just say yes or no, how many people have attended previous webinars or maybe didn't attend previous webinars. It's a great way for me to just to know how many kind of repeat audience members we have, and of course how many new people we have here, which I'm always keen to welcome. Just one moment, I'm just watching the screen just to see everyone's answer. So it's a bit of a mix, which is good. For all of you that have attended previously, thank you so much for continuing to attend my webinars here at MIG Bank. I've been giving these webinars now for just over 6 months, every month, and it is a commitment that I've made to do this every month. And for those of you that are here for the first time, welcome. I really hope that you enjoy this webinar and find it interesting. Keep in mind that this is more of a discussion. I really like to keep a two-way discussion going throughout the session, so feel free to ask questions. And after the webinar, feel free to stay in contact and send me emails or any questions that you may have. Okay, so let's get started. What are we going to cover today? So in the short time that we have, we're going to talk about 3 different parts. Part 1, what are the important signals that marked gold's extreme overbought condition? Now, I know we've seen a new record high today, and I will talk about that, but just keep in mind that this is still my view that the market in gold is still overbought in price and momentum terms, and I will kind of highlight a few points to why that might be the case. Part 2 is just basically talking about how gold's impressive long-term bull market may fall, and I emphasize may fall by up to 28% if we get a confirmation, a price confirmation below $1,600. That's the big figure for me. That's the magic number for me on the downside. And so a lot of my price levels I will talk about as upside trigger or downside trigger. So these are just price levels I look at, which will give me a strong indication as to where the trend will move, where the market will move. So part 2, why gold's impressive long-term bull market may fall by up to 28%. Part 3, how would such a major decline, if it happens, impact key related markets? This is going to be a short section, but I'd rather keep this open for discussion because there's been such an amount of news that has been driving the market recently. So I'd like to hear your feedback, agreement, disagreement with what I'm saying, just so we can have an open discussion as to how we can maybe understand what's happening in the market at the moment. Okay? So is everyone clear on what we're going to cover? 3 parts. Important signals that marks gold's extreme overbought conditions. Part 2, why gold's impressive long-term bull market may fall by up to 28%. Keep in mind that my trigger level is $1,600, so that is what we need for that scenario, that downside scenario to potentially take place. And part 3, if we were to have a major decline on gold, how would that impact key related markets? Now, let me just quickly answer some of the questions that you have posted here before I kickstart. So someone's saying, I enjoy your blog post on fxstreet.net. Thank you very much. My apologies for not updating it recently. I've been rather busy, and I'm going to try and add further posts over the next few days and weeks. Then one person is also saying, why do you think it's going down if every economy in the world is looking worse and worse and gold is a safe haven? Is it a pure technical assumption? Okay, so that's a very good question, and that actually sets me up for the main argument that I'm about to suggest to you. The big issue, and this is the picture here that we had on the front page, is a lot of people are very impressed with this beautiful uptrend that we've had for almost 12 years now, where the market has risen well over 600%. The problem here is the macro story for gold, and it's probably a goods problem, is so bullish. And most people in the market, investors, traders, but also the average day person out in the street, knows why gold is probably the best market to buy in this week, this month, this year, this decade. And it's probably the most popular, the most well-known asset that just about everybody in the market wants to own. Now, my question to everyone here, before I answer your question as to why I'm bearish, how many people in this forum are positive on gold? And if they are, how much higher do they think gold will move? How much further do you think gold will rise? So if you're positive on gold, how much further do you think gold will rise? We've made a all-time high today, a new all-time high, but I just want to get some commitment from every single one of you here. We've got up to 100 people in this chat room, and it's a great indication, sentiment indication, just for me, just to find out. So some people are saying up move until 2000. Some people are saying 2225. One person said up into the moon, possibly. Another person saying 2046 is a place for Fibonacci clusters to see heavy shorting. Another person saying 1996, 1995, 1998. So there's quite a few key upside levels there. Someone saying not at these levels, but bullish in general. And we have one person out of, one out of a clear minority, one person out of positive people that is saying it would go down to $1,400. So it's a nice mix. I'm glad that we've got a nice survey there. The conclusions of this mini survey is that almost everyone is bullish, and ironically, everyone that is bullish is only bullish up until $2,000. Now, what I will ask each of you to do is just to work out how far we are from $2,000. I'm not going to give the answer because it's very easy. We're only a few dollars away. But just for your own notes, work out the difference between today's high and $2,000, and you'll work out that it's just a few dollars price move. So interestingly, although we're all very positive and bullish on gold, we all know the macro reasons. As the gentleman just said, everything in the world is terrible and uncertain. And so with everything going from worse to worse, gold is the best, if not the only safe haven, especially after what happened today in Switzerland with the intervention on the Swiss franc, thereby forcing people maybe to invest and trade more into gold. So if this is the case and everyone is bullish, my question to you is why are the targets that you're giving me in this forum so conservative, given that we're trading around $1,900 already? Can anyone give me just a quick answer? I'll respond with my perspective, but I'd love to hear just maybe one or two views. If almost everyone in this forum is positive on gold, then why are the price targets that each of you have suggested to me so conservative? No one said $3,000 or $4,000. I know that is a view, but can anyone tell me why? So one person saying $2,000 is a psychological level. One person is, I think, joking with me and saying gold will go up to $10,000. I'll tune in next year for that. Some people are saying deflation, no money velocity, margin increase, and so on, and Fibonacci level. So people are giving me technical reasons as to why the market is likely only to go up to $2,000. And I think people are maybe, although they're very positive on gold, they're a little bit cautious as to how high gold can go from these levels. I'm guessing that people are saying this, A, because they maybe think price momentum in gold is rather extreme and overbought at the moment. So they believe gold will continue higher, but they're waiting for maybe a potential unwinding of momentum before the next move up. People are also highlighting the $2,000 level. Most people in this chat forum have said $2,000 is an important level, psychological level in gold. And I would hazard a guess that almost everyone in the market is thinking about this glass ceiling, this magic level, $2,000. And for that reason, we may see setbacks, we may see correction in and around that level over the next few days, weeks ahead. So why am I a little cautious on gold? It for a variety of reasons, macro reasons, but also technical reasons. And the technical reasons are, I believe that the market is very overbought, more than usual, and that this $2,000 level will actually provide an opportunity for price momentum in gold to ease and maybe reverse. And if we do get a confirmation below $1,600, then my scenario is for an even larger decline. Is that clear to everyone? Okay, so I'm going to move on now. Now, with all these beautiful Swiss Alps that we've been looking at on the previous picture, I also want to make sure that I show you the other side of beautiful mountains in the region, and that is avalanches. Just as wonderful as these mountains are in terms of their beauty and in terms of their height, how tall they are, several thousand meters high, gold, as I've mentioned, has now risen by about 662% in 12 years. And if you look at the annual chart, i.e. the yearly chart of gold, it's almost moved 12 years up on a consecutive basis. So we've seen higher highs and higher lows over 12 years, or maybe 10 to 12 years. So it's been a seriously bullish contender compared to any other market out there. Gold has obviously impressed all and broken most of the records. Now, having said that, nothing moves in a straight line, and this is the main point that I want to make to each of you. Although so many people, including myself, have profited from the rise in gold by up to 662%, keep in mind that markets tend to rise and fall intermediately, so there'll be long-term moves, but then there'll be medium-term and short-term counter trend moves within that cycle. So keep in mind that there are other reasons, maybe technical reasons, why gold may correct. And it's similar to maybe the analogy that I'm illustrating about a Swiss mountain or a Swiss Alp, where that you don't see the avalanche take place immediately. It's usually just a little bit of snow that actually starts to roll down the mountain, or each of you can research into this. But then what I'm trying to say is that after a while, the snow, the ice, starts to actually build up and domino into a big kind of snowball effect. And so over the last few weeks, I've highlighted quite a few reasons as to why gold has been overbought. And it's been very similar to maybe a mountain avalanche. We haven't seen a big correction yet, but there have been warning signals of this kind of snowball effect. Now, one of the key points I want to make before I go into the technical reasons is this a quote that I've put here on the screen, and that is, markets top not because of smart sellers, but because the last buyer has bought. So this is the technical reason why I think gold is very much at risk of a correction, a short or medium-term correction at these price levels into $2,000, because the amount of people that have bought, it has reached an extreme. It's reached a climax. And whenever that happens, according to various indicators I look at, and past history that I've analyzed, what that does is it opens up a kind of a vacuum. The last buyer has bought, and just because of that, it creates a vacuum. It creates a reason for the market to unwind lower. It's not because people start to sell. So I would encourage you not to think about gold reversing because of some big seller in the market, some big hedge fund, some big central bank offloading gold. Gold would likely correct, would likely lose momentum because too many people are buying gold. So just from a positioning, from a technical perspective, gold becomes overbought, and that's exactly what that term means, overbought, too many buyers. And so we get an unwinding of positions. Now, there are various reasons why I think there will be an unwinding of positions, and I'll start with the first point. So the first point is I'll probably say that we're entering this psychological zone of $2,000, much like when we broke through $1,000. These are big round numbers to everybody in the market, and it's very important. And usually what we get during these big round number levels is a transitionary stage. So the market usually consolidates or eases along these levels before they actually move into the next cycle or the next stage of trend. So I am bullish in the long term on gold. I do think it's going to go much higher than $2,000. My only point is I don't think it's going to happen now. I actually think that the acceleration in gold, much above $2,000 and higher, will actually happen second half of 2012. And I think between now and the first half of 2012 is actually the time when most markets capitulate, gold being one of them. Now, the key triggers I'm looking at is just on the screen. Downside level, trigger level is at 1704, and that's the hammer low, the hammer candlestick pattern low that we had, where we had the big reversal, 1704. And then beneath that, $1,600 is the big level for me, which unlocks a major decline in gold. So keep in mind, I'm not super bearish on gold on a short to medium term basis until we get a sustained confirmation below $1,600. On the upside, I only start getting really bullish on gold over the next leg when we get a move above 1935, so 1,935, and of course $2,000. I would really need to see a weekly close above both of these levels. Okay, is that clear to everyone? So I'm just giving you key levels on the upside, key levels on the downside. On the upside, 1,935 and $2,000. We would need a weekly close, not an intraday close, not a daily, but a weekly close. And on the downside, 1704 and 1600. 1600 is a big number. Okay. Now, one of the reasons why I'm using these trigger levels is because of the indicator that I use, DeMark indicators, specifically TD sequential and combo, which triggered another overbought signal on gold about a week or so ago when we had the $200 drop in only 3 days. And so it was a day or two before we had that drop that we had a signal highlighted on the DeMark indicator, that signal that the market had reached an extreme in price momentum terms and that there would be a correction. On this occasion, it was a very sharp correction, as I said, $200 down in only 3 days. The market reversed back higher thereafter. We made a new all-time high today, but interestingly, after the Swiss central bank intervened and basically made a very strong statement that it didn't want more safe haven flows into the Swiss franc because it was hurting exports in the country. They wanted the Swiss franc to decrease in value. Gold actually sold off. It didn't actually continue higher. Now, I'm not going to hazard a guess as to why that may have happened. Just keep in mind that the traditional expectation would have been for gold to really accelerate higher after what happened today from the Swiss central bank, simply because in a way the Swiss central bank is kind of forcing people out, forcing safe haven flows out of the Swiss franc into other safe havens. And of course the other safe havens that still exist are gold and treasuries, government treasuries. So it is interesting, and I would suggest that you all keep in mind how come gold did not, accelerate much above $2,000 today. Watch what happens tomorrow and over the week, but just keep in mind we didn't get that much of a big positive reaction on gold, which traditionally would have been expected after what happened today out of Switzerland. Okay, that being the case, I'm looking at this as a technical picture, and this DeMark signal, which was flagged a while ago, which led to the $200 drop in 3 days, produced a risk level. Now, for those of you that attended my last webinar on DeMark indicators will know what I mean when I say risk level. Risk level is a price point where the indicator, if the market moves above this risk level on a sustained basis, then the signal is negated. It no longer exists. So that risk level on the DeMark signal, which I've been talking about, is at 1935. If the market were to sustain a meaningful push above 1935, then this DeMark reversal signal that I'm talking to you about on gold would be negated. Not only would I need to see a move above 1935, but as I mentioned just now previously, also above $2,000 to really tell me that the market is very bullish on gold. Okay, I'm being very cautious on gold, and that's purely because I believe that all the price appreciation that we're seeing on gold at the moment is, although we're making money, we're also taking on too much risk. And so unless you're being very astute and very careful with your risk management, you've got tight stops, you maybe got a trading stop strategy, I would encourage you to be very risk averse in a position on gold unless you get a meaningful move above 1935 and $2,000. So someone's asking me which DeMark signal showed the drop in gold. DeMark's TD sequential, but indicator, that's one of the indicators. But there are various other proprietary indicators that he uses and some that I've developed myself that also highlighted this. But the one that I'm showing you on the chart is Tom DeMark's sequential indicator. It's very easy to look this up on the web, or maybe try and buy a book written by Jason Pearl. Used to be the global head of technical analysis at UBS here in Switzerland. He wrote the book, one of the latest books on Tom DeMark indicators. So if you want to read more about those indicators, I just mentioned the book. Now, one person's just mentioned to me, wasn't the price drop related to the CME increasing margin requirements? So the answer is absolutely yes. I've actually kept that point until the second half of my presentation. So if you can just bear with me, definitely, the Chicago Mercantile Exchange, the CME exchange in the States that actually managed the gold futures contract, did raise margin requirements on gold. Now, interestingly, they raised margin requirements at the same time when the market became very overbought. On a very kind of amusing level, I really do believe that central banks and market exchanges have technical analysts working for them. They seem to have uncanny timing for regulating the market or intervening into the market. I'll talk more about the CME margin increase, but I just want to save that point for now. So in short, yes, I completely agree with you. The CME increase, margin requirement increase on gold, definitely had a big effect on gold's correction. But my other answer is that was also in combination with various technical signals flagging an overbought condition. Now, one last point I want to make on this chart is that a confirmation below $1,600 would unlock further downside moves into the long-term 200-day moving average on gold. Keep in mind that this long-term moving average benchmark, the 200-day moving average, has not been tested by gold in 3 years. So in over 3 years, gold has never tested its long-term 200-day moving average, which is currently at $1,500. So if you're looking for potential exhaustion in the market, just for purely technical reasons and maybe some macro reasons like the CME margin requirement and maybe other points, keep in mind that a sustained move below $1,600 opens the scenario for a larger downside decline. The next level into that decline would be the 200-day moving average, which hasn't been tested before in the last 3 years, and that is currently trading at around $1,500. Yeah, talk about lagging indicators. But one of the points I would make to you, James, the gentleman that just made the point just now, is that the spread between a market's rise or fall, but in this case rise, the difference between the market's rise and its moving average is a great indication as to how overextended that market trend is. So if, for example, a market extends 100% above its long-term moving average, that then tells you that, yes, it's a very strong and powerful uptrend, but the risk of that trend actually reversing and mean reverting back to its long-term mean or average is quite high. So in this case, although it's a very lagging indicator because the moving average hasn't been tested in 3 years, keep in mind that still the difference, the price difference between gold and the long-term moving average is an indication in itself of how overbought the market can be and a signal of potential mean reversion back to the 200-day moving average at $1,500. Okay, so that's just a few points about gold's extreme overbought conditions. I am going to talk about cycle analysis and various reasons as to why that suggests the market is also in a risk zone. But now I also want to talk about this 28% figure. Why am I saying that the market may correct by up to 20% if we get a confirmation below $1,600? So the chart that is probably the most important chart that you're likely to see for a long time. It is one of my most important charts for several months now. So this is a chart that really means a lot to me, and I hope it provides useful information for each of you here. This chart is a long-term chart showing you long-term cycles on gold favoring a major peak. Now this chart is a chart dating back to 1999. The chart is showing you percentage movements in gold, and that's why when you're looking at the price scale, it isn't kind of a standard price gain axis. What you're looking at is percentage gains. So that's why, for example, between $1,000 and $2,000, you see this big price jump, $1,000 and $2,000, because the market doubled in value, and so the percentage scale also doubled in size. Now, the key points on this chart is that gold has been within this long-term trend channel, bull channel, since '99. I've basically drawn it from the peaks and from the troughs, from the highs and from the lows. And what you see is that the market has carved out a classic pattern, which technical analysts refer to as a throwover pattern. And that's basically when the market breaks above a long-term trend channel and then ultimately reverses back into the trend channel. So it's called a throwover. It's kind of like, think of a tennis ball kind of being thrown over this trend channel and then bouncing back into the trend channel. And so the point behind this signal, this classic signal, is that it's a false signal. It's a fake breakout from this long-term bull channel. Now, someone's just said you've put Elliott wave numbering on major swings in the chart. Is that reference to that we are not in a fifth wave, but actually in a sub 5 wave of wave 3? And are we set for major gains again after fall in wave 3 towards 4? Okay, I don't want to get too technical, but for those of you that look at Elliott wave analysis, yes, the numbers that I put on the chart, the 1, 2, and 3, the Roman numerals, are referring to the Elliott wave pattern. And what this is, it's just basically looking at price patterns, fractal patterns in the market, which divide into 5 waves, 3 impulsive waves on the way up, and 2 corrective waves on the way down. And basically, there are some people who are very bearish, very negative on gold, who are basically calling this a gold bubble. I am not one of those people, and that's why I do not believe that this is the final peak or the final 5th wave of this Elliott wave sequence. I am actually labeling this wave 3, and within that wave 3, as the gentleman just said, a minor wave 5 pattern. I don't want to get too technical, but for those of you that do understand Elliott wave analysis, it's just looking at price patterns in the market which are fractally based, and it just allows you to understand a roadmap, kind of a blueprint for the market. And the blueprint that I'm highlighting to you now in answer to the question that was just asked to me is that I don't believe that this is a final peak in gold, so I don't believe that gold is in a bubble, and for that reason, partly for that reason, I'm labeling the current high in gold, which may go into $2,000, as a major wave 3, where we will get a correction into wave 4, that will then possibly into the second half of next year produce a fantastic buying opportunity for gold into from the second half of 2012 onwards. So that's the roadmap. That's the very long-term picture that I'm highlighting to you. Is everyone clear on what I just said now? So I'm not labeling this as a major high or peak in gold. I'm not saying that gold is in a bubble. I'm just saying that we're going to have potentially the risk of a sharp correction, which would, in Elliott wave terms, be a wave 4 major degree correction, which would set a lot of investors and traders up for a wonderful buying opportunity in the second half of next year, 2012. Is everyone clear on that main point? Any questions on that macro point? Yeah, so good question. So someone's saying, but you said that long-term cycles favor major gold peak in your presentation. So the long-term cycle being the trend channel, what I'll say in answer to your question just now, it's the intermediate cycles within the long-term cycle that actually favors a major peak. So maybe I should correct the title of my chart. It's actually the intermediate peaks. So you see the red arrows that I've highlighted here on the chart, 1, 2, 3, 4, 5, 6, 7, and then 8, the current move that we have in gold. This is showing you intermediate, so medium-term cycle peaks in gold, which is roughly a 1 year plus cycle. And what it shows is that the current timing of a potential peak in gold coincides with its current overbought condition, which moved above this long-term 12-year bull channel. So this classic throwover signal, which I mentioned, where it basically tells us it may be a potential false breakout to the upside, which may bounce back into the trend channel. So the intermediate medium-term cycles are telling you that right here, right now, gold is due a medium-term to short-term correction. So that's my answer. Now, one of the key points is that if we do get a sustained meaningful close below $1,600, which is the top of this trend channel ceiling, which I've highlighted here in green, then that will confirm the classic throwover signal, which I've been talking to you about. And keep in mind the throwover signal, think of a tennis ball which has bounced out of this 12-year trend channel, which may likely come back to the ground. Gravity will pull it back to the ground beneath $1,600. If that does happen, it will confirm the throwover signal and then open the door for a potential large decline. Now, in terms of how much of a large decline, what I've mentioned in various reports and in a recent television interview on CNBC is that the correction is likely to be, if it does happen, is likely to be up to 28% in percentage terms. So up to 28% potential decline. One of the reasons why I say that is because so many people are so positive and so bullish on gold for macro reasons, for fundamental reasons, even for technical reasons, some of the industry colleagues that I speak to on a day-to-day basis. And what I'm concerned by is that not many people are actually looking at the downside risk on gold, which I'm telling you is high because of the overbought nature of the market, because of this cycle analysis that I'm highlighting to you and various indicators that I'm using. And when they're looking at the downside risk, there aren't many people in the market that are actually talking about how much gold may correct. Not many people are factoring in or quantifying even how much gold may correct by if it were to confirm a large decline. And so one of the simple things that I've done is look at the largest corrections in gold over the last 12 years. So during gold's long-term bull cycle, the biggest corrections which have taken place, how big were they? Just simple analysis that you can do in any market, a bull market or a bear market. But it is very important because it allows you to understand the nature of that market, how volatile that market is. It also allows you to manage your risk, which is probably one of the key messages in this webinar today on gold. Now, if we look at the three biggest corrections in gold, the three biggest drawdowns in gold over the last 12 years of this bull market, we come up with three periods of time. One is 2008. That was the just in and around the financial crisis when we had a big turmoil in the market, and it was a nightmare situation. We had Lehman Brothers collapse and various mortgage issues taking place in the mortgage market and so on. Then in 2006, we had a 26% correction in gold. And then the last but not least correction we had in gold was just at the start of the bull market, and that was a 25% correction. Yes, I have looked at corrections even further out than that, but I'm just choosing the corrections in this most recent bull market. But I have looked at corrections even longer term than that. Thank you for that question. It's a very good question. I would actually encourage everyone to also look at corrections even further out in history, because that does give you some interesting points. Now, the average of all of these corrections is about 28%, and so that's why I'm giving a ballpark figure of 28%. It's just an average drawdown. Most people do this with their portfolio analysis, where they just look at the largest drawdowns in their portfolio, and it gives just a rough estimate of your downside risk in any portfolio, in any market, and in this particular case in gold. Now, one of the points I want to stress here, aside from the quantified downside risk of 28% on gold, keep in mind that one of those downside corrections in gold happened in 2008. Now, I said this point very quickly, but I didn't stress it enough. Can anyone tell me what is interesting about gold correcting up to 34% in 2008 during the financial crisis? What is interesting about that point from an economic perspective? Why is it interesting that gold corrected about 34% in the year 2008? What is interesting about that point? Recession and dollar smile theory, agreed. The stock market, yes, the stock market was selling off during that period. It was an uncertain period economically and politically. And a lot of people buy gold. Why do people buy gold? What is the economic or the macro reason why people buy gold and why people are so bullish gold at the moment? Yeah, in 2008, gold should have gone up. Why should gold have gone up in 2008 when the market was in a financial crisis, big turmoil in the market, economic and political uncertainty? So people are saying people buy gold for safety. They buy it as an alternative to the dollar, liquidity crunch. Yeah, but there's a whole bunch of reasons, and all of those reasons are correct. So gold really should have risen during that time, but for various reasons, gold declined. I won't go into why it declined because there are many reasons, but just keep in mind that gold does not rise to the sky every single time. There are examples in history where gold does decline during economic and political uncertainty, even though gold is traditionally known for its safe haven quality, i.e. people buy gold when they are very uncertain what else to buy, and they're very scared about the existing markets they trade in. So keep in mind, traditionally that is true. Gold is the best market to hold, to buy, when times are uncertain, when there's a big crisis. But keep in mind that in history, there are examples when gold has declined, even though the markets have been uncertain. In 2008 is the most recent and most interesting example that I would really encourage all of the people here in this webinar to keep in mind. So keep that in mind. We don't have that much time to go, so I just want to quickly highlight the point. There are a lot of people in the market, on the news, television, newspapers, and various market commentators that are just telling you the reasons why gold will rise, but they're not giving you exceptions to the rule as to why maybe gold may decline, and they're not maybe quantifying the risk of how much gold may decline in this very overbought situation. Now, the last point I'll make is the only way you're really going to know that gold is overbought is when you look at the long-term picture. If you're looking at gold on a daily basis or an intraday basis, all you're seeing is new record highs. So a big part of my analysis is cycle analysis, and I would really encourage you to look at the big picture because it does give you perspective. And when the market is very volatile and it's moving maybe $100 in a day or several $100s in a week, it is better to look at the long-term picture, the long-term cycle, just to get a better perspective to your risk-reward ratio and to any kind of historical points that may be important to understand. Okay. Any other questions on this now? So someone's saying gold news is everywhere these days, from market to regional news channels all over the world. That ascertains that there's a bubble in it. Is it not? To an extent, I'm very hesitant to kind of use a contrarian standpoint on all the news and all of the overheat in the gold market, because gold has been overbought for a long time, and so it's very important to understand how overbought is overbought and how bullish is bullish, and so on. So the news is not that easy to use as a counter trade condition. I would agree with you that there are a lot of people that are very bullish at the moment, and that does tell me that the market's overcrowded. Gold trade is overcrowded, but I would say it's overcrowded for a short-term to medium-term correction, not for labeling this a bubble. So if you are going to use news as a sentiment indication as to how over extreme the gold market is, keep in mind the difference between short-term, medium-term, and long-term. My view is that all of this hype in the market over gold and why it should be such a bullish market, why gold should rise to the moon, keep in mind that I don't believe it's a bubble, and I do think it's going to correct by a short-term to medium-term basis, not a long-term reversal. Okay. Now, some of the other reasons why I'm bearish on gold, or at least looking on the downside risk, is because of the measures of liquidity. The three types of indications I look at in any market every day that I analyze the market. First one is momentum. Second is volatility. And third is liquidity. Momentum tells you how fast the market is, the speed of the market. Is it overbought? Is it oversold? Volatility tells you the risk of that market. And liquidity tells you how much commitment there is in the market. Now, people can be positive, people can be negative, but more important than positive and negative is if they are putting their money where their mouth is. And this is a key indication because this tells you how sustainable a market rise or a market fall is. So in the futures market, when you're looking at markets like gold, it is very important to look at things like CFTC data, which is actually produced, sent out by the exchanges in the States, which tells you how many people are buying the market or how many people are selling the market. The chart you're looking at now is telling you the number of net large speculator positions. So this is telling you how many net long speculative positions are in the market. Speculators tend to be on the wrong side of the market at the highs and the lows. They tend to be trend followers. And so this can be a good counter trend indication on any market. Now what this shows is that net long speculator positions in gold actually peaked in 2009 when gold actually punched up above $1,000. So when gold broke above $1,000, that previous magic level, the number of people actually buying gold peaked. It then moved sideways within this trading range, which peaked two other times. And the last time was actually when gold capitulated $200 in 3 days, just recently. And we had this third peak that I'm just highlighting here with the cursor. Now, this suggests to me that we should be focusing on this chart quite a bit because if gold's liquidity numbers were to break below 0.2, this key structural level, it would suggest that over 2 years of sizable long positions in gold would be under threat. So keep in mind, if you're able to get these figures, I think you can get them on FX Street. You can definitely read them on our MIG Bank research reports because I publish these on a weekly basis. If gold's long buying positions were to break this 2-year level, it would unlock a lot of overextended buying pressure or buying climax in the market. Is that clear to everyone? So we're just looking at liquidity figures which are sent from the futures exchange in the States, and this is showing you the net large speculative positions in gold. It shows that the net long positions peaked in 2009 when gold actually punched above $1,000 and has been moving sideways ever since. The last reversal, downside reversal, was actually when gold capitulated by $200 in 3 days. And if we were to break below 0.2 contract size, that big long-term structural level that I've just highlighted in red, over 2 years of sizable long positions would be under threat. And so all the macro reasons, all the economic, all the fundamental reasons for owning gold would still be valid, but keep in mind, they would be put on ice for some times. They would be put on hold for maybe a few weeks, a few months, in my opinion, up until the second half of 2012. And during that time, there would be a massive technical unwinding or positioning unwinding of gold. So try not to mix up your macro bullish views on gold with a potential technical overbought condition which needs to unwind at some point in time, potentially around these levels in and around $2,000. Okay, is everyone okay on what I just said? I'm talking a little quickly here just because we're about to finish in 5 minutes, and I just want to make sure that everyone's clear on what I'm saying. Now, the last point I'm going to make is that is actually an answer to the question that was asked about 20 minutes ago. One of the reasons, one of the catalysts to this potential massive unwinding of long gold positions is, in my opinion, down to the big squeeze which the exchanges in America have actually triggered on gold traders and investors. The CME, the Chicago Mercantile Exchange, hiked margin requirements on gold by 55% just before gold capitulated by $200 in 3 days. And this is very reminiscent of what happened to silver not so long ago when it peaked at around $50. And I'm just showing you here a chart of silver and that massive acceleration into $50, which was where silver had previously peaked in 1980. The exchanges had also similarly raised margin requirements during that overbought situation in silver. During that time on silver, they actually raised it by up to 80%. So during the accelerated and unsustainable rise in silver, when it rose into the psychological $50 level, the CME also similarly hiked margins by about 80% in only 2 weeks. And you have to keep in mind, I mean, if you've got a long trade position on gold, and suddenly the exchange or the brokerage you trade with tells you that suddenly your margin requirements have increased by 50 or 80%, that is going to be a massive squeeze on your position, and it may just by definition force you to scale back your position, or if you don't have much money to play with, maybe actually close out your position. So just that fundamental reason may actually trigger or may coincide with all the other reasons as to why gold may capitulate and encourage a massive correction on gold. Now, the last point I want to make is how would such a major decline impact key related markets? Because we're running out of time, I'm just going to make a very quick point in that I believe that if gold were to correct over the next few days and weeks and confirm below $1,600, below $1,600 would unlock that larger decline, that avalanche decline of this mountainous rise. But keep in mind that that would also potentially be against the backdrop of a further uncertainty and turmoil in the market. So my opinion is that volatility in the stock market and in various risk markets will continue to unwind and even potentially capitulate violently over September and October, which is seasonally a very volatile period. We've already had a very volatile summer period, and what I'm trying to say is that we may get an extension of that as economic contagion, negative contagion increases in Europe and in the US and various other parts of the world. It may actually unlock various recessionary issues and many other event risks, very similar to what we had in 2007 when Lehman Brothers, as an example, actually became closed down, and we had many other big issues during that time. Now, in such a situation, when investors and traders are being forced to sell their assets, their risk assets, they've traditionally looked at Swiss franc. The Swiss central bank has clearly made a meaningful statement today that it does not want investors and traders to use its currency as a safe haven home anymore because of these extreme levels. They're unprecedented. They're impacting the country's exports and many other challenges. And so for that reason, they've intervened and they've put a floor in the market, and they're saying that they will do everything in their power to defend that floor. So people are potentially going to switch from Swiss franc into other markets. Gold potentially, but I believe technically it is so overbought that for technical reasons alone, that may produce a massive unwinding. What else? Treasuries. Treasuries are already at historic lows. And so the next market that would really receive and benefit massive safe haven flows would actually be the surprise market of all, the US dollar. And so this has been a long held view of mine that the US dollar, and this is the chart of the dollar index, DXY, is more than likely to receive safe haven flows in another downturn scenario where potentially we get a perfect storm of negative economic indicators, GDP, unemployment. We already had unemployment in the States last week, non-farm payrolls in at zero. I believe this will be even more negative over the next few months. We have European figures coming in negative. We have peripheral countries in Europe already acquiring even more negative news. if the markets were to sell off, if the markets were to confirm all the negative news out there, then people will be forced either into cash, and in terms of market, the last market standing, the last safe haven market standing, which has actually held up very well during all of these weeks and months where we've had a lot of volatility, is the US dollar. And so I believe that a potential major gold decline and global risk appetite unwind may encourage renewed flight to US dollar, which would likely see a move up to 30% over the next 6 to 12 months. So if any of you are looking out for opportunities there in a potentially ongoing volatile environment, keep in mind the US dollar is likely to receive a lot of interest in the next 6 to 12 months, and I believe an interest of up to 30% price value on the dollar index. Now, there's a certain reason why I'm saying 30%. I'll talk about it in my next webinar in October, which is going to be focusing on the US dollar. Quite rightly so, people are saying that the US might be forced into stealth QE3, and China trying to get rid of all of those pesos. Swiss franc is not going to be treated as safe haven henceforth, or is just contemporary to market conditions. Silver, so far as metals go. Keep in mind that a lot of the commodities are in capitulation mode as well, and gold is actually diverging from all those other commodities. And yes, I believe that could potentially be the time frame or period that gold declines by up to 20%. Keep in mind that gold needs to confirm below $1,600 on a weekly basis for that downside scenario to unlock into a potential up to 28% decline. A massive correction on commodities and on gold in particular is more than likely to encourage an opposite reaction to the US dollar. Remember that there's a traditional inverse relationship between the US dollar and commodities, and specifically gold, simply because commodities and gold are priced in dollars. So whenever gold rises, the US dollar generally falls, and vice versa. If gold were to undergo a major decline, that would also, just in terms of the negative correlation with the US dollar, allow the US dollar to rise by a substantial amount. In addition to the potential flight to the US dollar because of the limited amount of other safe haven homes that investors and traders are allowed to go into. Remember, the Swiss franc is no longer friendly to people who are looking for safe havens. Treasuries are already at historic lows, so there isn't much more safe haven play in treasuries, in my opinion. And gold is very overbought, so any safe haven play into gold may take it into $2,000, that magic psychological level. But for technical reasons and maybe various other reasons, gold may unwind substantially, especially if it were to have a meaningful close below $1,600. So there's a question here. 2-month time frame for the 28% decline. Let me just quickly answer that question before we run out of time. So a lot of you obviously want to know, if there is going to be a big correction in gold, how long will it take to happen? Now, there is no right and wrong answer here, and obviously the $1 million question is when, and being able to time market moves. That is where the big money is in this market. And the rough guesstimate, estimation that I'm going to make here is that I believe that any major correction in gold is likely to be very violent and dramatic. And the reason for that is it actually comes partly down to the very overbought nature of gold, as you can see here on this long-term chart, 12-year chart of gold, and this throwover signal, which may capitulate. Keep in mind it may capitulate below 1,600, but then have a maximum move down to about 28% and maybe lower, maybe the base of this trend channel. But keep in mind, for those of you that actually look at Elliott wave analysis, wave 4, correction wave 4, which is what I'm labeling this as, this potential correction, tends to alternate to the prior correction. So the pattern of wave 4 tends to be different to the previous correction. And the previous correction is between wave 1 and wave 2, so the wave 2 correction, which was in 1999, a correction of 25%. That was a very steady sideways correction. So the guideline, the Elliott wave guideline of alternation, suggests that if we do get a correction, this major wave 3 peak correction, wave 4, will likely be a violent, dramatic correction. That also makes sense if you just look at the sheer exhaustion of gold's rise above this 12-year trend channel, which has produced this classic throwover signal. Remember, the throwover signal is like the tennis ball bouncing outside of this long-term, very important trend channel, and then potentially bouncing back. Gravity then pulls that ball back from the air into the trend channel below $1,600, and then potentially down 28%. The last point I'm going to make is the point on US dollar. I'm very bullish on US dollar, and of course, a big move on US dollar does affect many other currencies. Euro dollar, I believe, is going to move much lower into 137.70 and 134.10. Those of you who look onto my section on the FH Street website, or even look on on our MIG Bank website, I encourage you to look onto there. You can see my report on Eurodollar, where I cited a potential fall from grace into 134.10. Also, keep in mind that that was on the back of a very positive view on the US dollar, which will be encouraged by a potential decline on gold and other commodities, and an unwinding global risk appetite. Now, I just want to answer the last few questions before I end off. Who makes the move down? Do banks tell each other, okay, let's sell at the same time? Or how can somebody create such a violent move? That's a very good question, and please keep in mind the point that I made a while ago. I'm going to go back to that slide just to crystallize my answer to that question. Markets top not because of smart sellers. I'm going to repeat that 2 more times. Markets top not because of smart sellers. Markets top not because of smart sellers, but because the last buyer has bought. Part of the reason why gold might have a very sharp correction is because there are too many people buying gold at the moment, and by actual literal definition, the market is overbought. And so from a momentum technical basis, if we were to get a massive unwinding of these long positions, remember I'm showing you this chart of net long positions in gold. If we were to get a sharp decline below $1,600, that would appear on this liquidity indicator chart, and that would encourage a break below this structural level, which would unlock over 2 years of sizable long positions. So just by that, just by the number of overextended positions which would potentially be unlocked, 2 years of sizable long positions being unlocked to the downside, that in itself would produce a violent correction. Keep in mind that when we get sharp corrections in the market, whether it's led by speculators or whether it's led by central banks or various other market players, there is a market theory called feedback loop, which basically just means momentum feeds momentum. People see selling in the market, and so it just feeds off itself. Momentum feeds momentum. So people start selling, and then more selling is created, and it creates that avalanche. I'll go back to that picture. Remember the Swiss mountain Alp. You have this beautiful rise, but then you can have an avalanche from that mountain. And avalanches don't usually start in a very big way. Usually you get just a small shake, a small kind of increasing snowball effect happening in the market. And this is exactly the same in the markets. Just as mountains avalanche and start very small and then start building up into this very strong avalanche, this is exactly what is likely to happen in gold and various other markets. Now, I've said quite a bit there. I just want to kind of answer any other questions. Keep in mind that the CME hike of about 55% in a very short space of time is a very good trigger for a potential correction in gold, and it is generally a sign. This is generally a good signal of a potential market capitulation, and we did see something similar to that not so long ago in silver when it crashed by up to 30% in just 1 week. And during that time, just before it corrected, just before silver capitulated, the CME also raised margin requirements by up to 80% in only 2 weeks during that acceleration stage. So I'm basically saying that gold may potentially unwind for technical reasons. It's very overbought. There are various intermediate cycle analysis I'm looking at that suggests that every year and a bit we get these major peaks, major intermediate peaks in gold. which suggests that this current rise in gold is a risk zone. It's also a throwover signal, which is an Elliott wave term for markets that break above long-term trend channels and may potentially produce a fake buy signal, which generally capitulates back into the trend channel and usually the lower boundary of that trend channel. So someone's asking me, you have mentioned what is the peak temporarily, or would it be right to short now? If yes, where? Looking for trade suggestions to at the end. Okay, let me go to the top of my presentation. I would say if you are currently, keep in mind, I have to kind of actually highlight just a quick legal disclaimer. Here at MIG Bank, where I work as a technical analyst within the research team, I'm not obliged to give trading recommendations. This is purely educational commentary and observations that I'm sharing here with you. What I will do is just tell you maybe key levels that you might want to keep in mind. If you are currently already in a long position in gold, I would encourage you just to have very strong risk and money management overlays. So this is not the time to leverage. This is the time to have very good risk and money management filters in your trading and in your investing. If you're looking for positions to short the market, or if you're looking for positions to actually downsize, reduce your existing position in gold, the levels that I'm watching every single day over the next few weeks and months is 1704 and 1600. These are the critical levels for me. Now, it is very far from where we are right now. I'll let you choose other levels which are slightly closer to the market price. But these are the key levels that I want to highlight during this webinar. Upside levels. So if I'm wrong, if this short-term DeMark reversal indicator is wrong, then we need to get a sustained move above 1935, which is the risk level, which is incorporated into this TD sequential indicator. And more than that, I would really need to see a weekly meaningful close above the $2,000 psychological level for this trend to continue higher. Now, if this trend were to continue higher above $2,000, I think it would be limited up to $2,400. I really don't see much above $2,400 at this moment in time. I believe that gold goes much higher, but not now. Right now, I believe that we are in a risk zone. I'll go back to my cycle chart, a risk zone at the moment from current levels up into $2,000 and potentially into $2,400. I don't believe the market will go further than that. And I believe that we will see consolidation or a major reversal into the first half of 2012, and the second half of 2012 may produce a very good buying opportunity where gold will likely go even further than $2,400 and then higher. Okay, now people are asking me about what about dollar pairs do you favor? Okay, so a lot of the I'm seeing a lot of bullish US dollar trade setups on a lot of markets right now. Canada and Australia dollar are definitely very key markets. They're already in reversal mode at the moment. So dollar Canada is moving sharply higher. Australian dollar is moving sharply lower, and I really believe that these currencies are going to reverse in a very big way. Also look at some of the emerging markets. Look at the Mexican peso. Look at the Russian ruble. Look at the Turkish lira. Look at the emerging market currencies and look at the commodity-driven currencies. So the currencies of countries which are very rich in commodity and resource production. So countries like South Africa, countries like Australia, countries like Canada, countries like Russia, Norway, all of these markets which either are the biggest producers in gold or precious metals or oil or various other markets are likely to underperform over the next few months. And the US dollar is likely to outperform each of these currencies in a very big way. And this is also another reason why I'm very bullish on the US dollar index, because if you look at each of these charts which I've just mentioned, you will see potential massive reversals on each of these currencies. So keep in mind commodity-driven currencies and emerging market currencies. So someone's saying, why if you saw the Tom DeMark exhaustion signals, didn't you sell recommendation on the data recommendation? I've been caught out on the gold position several times. I'm definitely not going to stand here and say that I've been early on the trades. I've basically, on a personal note, I'll tell you that I've been very cautious on gold, on the upside and on the downside. And a lot of the time, this trading model that we have, just giving kind of just general performance observations on the gold, on the market, is an indication just for people just roughly interesting positions, interesting kind of levels to look at. On the gold position, I am looking to sell in our model educational portfolio, but I'm waiting for confirmation. Some of the hardest things about markets which accelerate to the upside or accelerate to the downside, fast-moving markets are very hard to time. And so although my analysis is telling me that the market is likely to reverse, markets can easily overextend or produce false signals. So for that reason, in answer to your question, that's why I don't have a sell recommendation at the moment on gold. I have put several sell recommendations on gold on our model portfolio over the last few weeks, but I've been stopped out on those sell recommendations, as I'm sure some people in this chat have already experienced in their own portfolios. But keep in mind the big level that I mentioned, $1,600, as being a level that you really want to watch, because if we do get a meaningful correction beneath that, that will tell us that the market is likely to capitulate up to 28%. That fits in with the average drawdown that I've measured over the last 12 years on big corrections within gold. I've mentioned this in a recent CNBC interview with CNBC Europe Squawks Box, so feel free to watch that if you want. And keep in mind that a big correction in gold, which is likely to be driven by an unlocking of over 2 years of sizable long gold positions, if we get a close below $1,600, will actually have a massive effect on in my opinion, the only last safe haven play left, or the only good safe haven play left, and that is the US dollar, which tends to do well in uncertain economic and political times. It is seen as a traditional safe haven play. Even though the US dollar is the most hated market at this moment in time, I really do believe that for economic, technical, and sentiment reasons, this market has the most upside potential. Keep in mind it is very oversold. It is at sentiment extremes. And if you look at liquidity readings on US dollar, we are at negative short positions in US dollar. So for many reasons, economic, fundamental, and technical, the US dollar is likely to appreciate, in my opinion, over the next 6 to 12 months by up to 30%. And in terms of trading ideas on the back of this, I would look at all your currency blocks, look at your emerging markets, look at your commodity-driven currencies, because in my opinion, a lot of these are in major reversal setups. And as mentioned before, Canada, Australia being one of the two of the currencies that are in major setups, but also other emerging markets like Mexico, Russia, and so on. I'm going to wind down on that, and if there's maybe any last-minute questions, please feel free to ask. Meantime, if there are questions you want to ask later on, please just email me on r.william@migbank.com. I'm more than happy to answer questions, and all of you here that have attended previously do know that I answer questions very quickly and comprehensively. If you would like any examples of some of the charts that I've used, I'm very passionate about illustrative charts and visualizing my ideas in charts. I'm more than happy to send them to you. And last but not least, our marketing team have kindly allowed us to extend a 1-month free trial of all our MIG Bank research reports to anyone here that's attending the webinar. Just send me an email and I can send you out our latest report. We send out every day. We cover foreign exchange and commodity markets, and soon CFD futures markets. So that's it from me. One of my key mantras is enlightenment to realize knowledge. I really, really believe that everyone's gained some value from this webinar, and I look forward to the next one. It's been an honor and a pleasure. Thank you very much, FX Street, for another invitation. And please sign up for the next webinar, which is on the US dollar. If some of the team at FX Street could just kindly put in the link for the next webinar, which is in early October, and that is on the US dollar. So if you want a big focus on why the US dollar may rise by up to 30% over the next 6 to 12 months and how that will affect your trading portfolio, sign up to the next webinar. These webinars are getting overbooked, so please feel free to sign up as soon as possible. And send me an email if you would like to ask questions, if you would like me to send you charts, or if you would like to take advantage of our exclusive 1-month free trial. Thank you very much for everyone attending. All the best. Ron Williams, Technical Strategist here at MIG Bank, Switzerland. Thank you very much. Bye-bye.